Welcome back to the Costing and Pricing Learning Program. My name's David Gilchrist, and this is webinar 6 in the series, Control in Costing and Pricing. Before we get into the main part of the webinar, I would like once again just to remind everybody of the copyright arrangements that apply to the Costing and Pricing Learning Program and which allow free use of these materials, but with certain restrictions. So it's worth coming back and just having a look at those restrictions and making sure you're comfortable, particularly if you're intending to use these materials commercially. The other thing I'd like to point out is, of course, that this webinar is part of the Costing and Pricing Learning Program, and as such, throughout the webinar slides there are markers that help you to navigate between different sources of information and materials within the broader program. It's particularly important to remember that these webinars are really designed to give just a brief overview of particular topics to help identify the key issues and to allow you then to be perhaps better placed as you go into the more substantial materials such as the study guide, the macro case study, and also documents like the NDS Curtin National Costing and Pricing Framework. So it's worth just making sure that you recall that all of these materials go together to form the Costing and Pricing Learning Program. The previous webinar, so the webinar number 5, looked at pricing practice specifically. In this webinar we'll look at control in costing and pricing, and in the next webinar we'll have a look at costing and pricing under the NDIS. Let's have a look at the purpose of this webinar, looking at control in costing and pricing. As a result of reviewing this webinar, you should be able to understand how to utilize the costing and pricing data that results from the processes described in the last 2 webinars particularly. You should be able to learn how to analyze and understand the target price gap, which we have emphasized right the way through the Costing and Pricing Learning Program as the principal area or opportunity for you to control and ensure financial sustainability for your organisation. And finally, we'll just have some comments around reporting styles and information that might be used to deliver key messages to the board, senior executives or others within the organisation, both to control risk but also to inform the organisation about how well the organisation's operating under a new pricing regime. This slide, identifying the target price gap, should be extremely recognisable to you. We've now dealt with this particular slide in each of the webinars leading up to this point, and I think there's just a couple of things that we need to make sure that we reinforce before going on to the content. The first is, of course, that when you are undertaking a costing and pricing process, you're looking to try and identify the target price for each UOM, or unit of measurement, which is the actual iteration of service delivery that you provide in the disability services sector, and to compare that with the achieved price. That is the price that's actually provided by a funder. So the example in this box shows that we would include the price offered by the NDIA for services rendered. It's the difference between the target price and the achieved price, or the target price gap, that we're really keen to understand, because that really does help us then to help plan and strategize around achieving sustainability. The difference between the target price and the achieved price is that target price gap. And we make this calculation for each individual service we deliver, as well as for the organisation as a whole. If the target price gap is positive for a particular service, that's fantastic. That's what we want to see. But we also might be inclined to go back and just recheck our calculations to make sure that we've got that correct. This is particularly the case in the Australian human services sector, because systemic underfunding of public goods in Australia means that such a result is actually quite unlikely. If it's correct, this is a very good thing. If the target price gap is negative, you need to examine the impact of this on your organisation and determine the best way to remedy it. The gap might be negative, but it might only be negative because, notwithstanding your immediate costs are covered, future costs covering things like depreciation and working capital might mean that in the immediate sense you're economically sustainable, but in the medium to longer term you might have problems replacing assets, etc. So it is pretty critical that you understand not only the quantum of the gap, so how much the gap is, but also the causes of that particular gap. So if the gap is negative, you need to examine the impact of this on your organisation and determine the best way to remedy it. If the gap is caused because you are not paid enough to cover your margin, this will have a medium-term impact on sustainability. On the other hand, if the gap is caused because your organisation is not paid enough to cover your margin and things like depreciation, you might find that it has an effect on your medium to longer term sustainability. Of course, in the short term, it's absolutely critical that any service you provide has its costs covered. If not at the individual UOM level, so the individual item level, at the aggregate level for the whole organisation, you need to make sure that you have at least a neutral price gap to ensure your costs are covered. In doing so, in looking at the target price gap, we need to be concerned with things like the cost to deliver each service, each individual service, the price received for each individual service, and the gap between that cost and the price. More importantly, and we'll talk about this a lot more in this webinar, we need to talk about and understand the cumulative effect of each of those gaps calculated by multiplying each gap by the quantity of each service provided and then adding these to find out if the service mix delivers a positive or negative target price gap overall. That is, at the corporate level, we need to have a positive or at the very least a neutral target price gap to ensure our immediate, medium and longer term financial sustainability is assured. In doing this, we need to consider the service mix. The service mix is an incredibly important tool because it allows us to strategize by still delivering some services that might not be delivering us a suitable financial return, but might have incredible relevance to our clients or to our objects as a not-for-profit or charitable organisation. The service mix is also an important element of the control process for costing and pricing. When we talk about the service mix, we're actually talking about the macro level or the whole of organisational level combination of services and prices that are achieved. It becomes more complex, of course, because we can also not only consider each service individually and combine those, but actually each service can attract its own price depending on the market that it operates in, and it can also be subject to different costing and pricing rules depending on how your organisation operates. I know I'm overemphasising this, but I think it's an important point. At the end of the day, the aggregate target price gap is ultimately the issue that you're concerned about to ensure ongoing financial sustainability for your organisation. Now, the service mix has also a number of other constraints, so we can't just simply adjust the service mix according to our strategic desires. We do have to, of course, take into account things like demand for certain services, the target price gap for each service, because the quantum of target price gaps will make a difference to our financial sustainability. The relevant range for each service is also incredibly important. We can't simply change our service mix and move into or out of a relevant range without having that detrimentally affecting our costing and pricing calculations. Going back to webinar 2 and 3, in considering the relevant range would be a really important step for people who are not comfortable with that particular item or idea. However, the relevant range for each service and our capacity to increase or decrease certain services without changing the cost base from which we derive our target price gap is very important to understand. And finally, of course, as I mentioned before, the mission of the organisation might see us providing services for other than for-profit reasons. In other words, services might be provided because we feel it incredibly important that we provide a rounded and holistic service to our clients, and also to ensure that some people don't fall through the gaps that might otherwise fall through the gaps if we were simply worried about ensuring we achieve that target price gap. It's important always to remember that we're concerned with the target price gap ultimately at the corporate level. Let's have a look at this idea of service mix in practice by looking at a commercial organisation. Now the next few slides actually deal with this example, and it's a fairly simple example, but I hope it does help to cement the concept in your mind. While this is an example of a commercial organisation, it is no different to stepping out the products or the types of services you provide and all of the other information that might be relevant to your organisation. So this is just Acme Chemical Company. The numbers are purely made up. There's no history or reality to these charts other than to demonstrate the outcome that we're talking about. This chart shows then the target price gap and cumulative target price gap for a chemical company that provides or makes detergents, cleaners and so on, as you can see. It's important to note that all of the target price gaps are positive. This is fairly usual in a commercial entity. It's very unlikely for a commercial entity, of course, to accept a target price gap for a product unless it's a loss leader or they have some strategic purpose to that. Of course, it could be different for a disability service organisation where it might be that the target price gaps are all negative, but we are working towards closing that gap by agitating for more funding and advocating, but also by increasing efficiencies of our organisation, which were discussed in the prior webinar. If we look at this target price gap and the expected sales, so the expected quantity of items delivered, you can see that multiplying those things out gives us the cumulative target price gap for each item, as well as the expected cumulative target price gap, or in other words, result for the company for that year. If we change the service mix, or in this case the product mix for this organisation, by changing the expected sales quantity, so we haven't affected the target price at all, which in the short term is a very logical expectation for us, then you can see that there is quite a significant change in that expected cumulative results. Some products have returned less of a target price gap, in other words, have performed more poorly, and some have improved. However, the overall presentation of the cumulative price gap is different. Let's have a look at a third example of that, and we're just simply making up these figures to show people how the target price gap works at the cumulative service mix level. Again, we've modified the expected sales. We haven't modified the target price gap because this is a short-term view, and you can see that modifying those quantities of sales makes a difference again in terms of that expected cumulative result. Let's have a look at that exercise overall. As you can see, the net result for each scenario was very different, with scenario 3 being, if you like, an optimal service mix or product mix for this particular company. When you look at that scenario 3, $844,000 being the proposed target price gap, the cumulative proposed target price gap, it is a more attractive gap than scenario 1 or 2 because we've got the right order of emphasis, if you like, on the products that we deliver. Similarly, disability service organisations need to understand that target price gap, the activity levels for each UOM, unit of measurement, that they can possibly deliver, and then to be able to make the extrapolation to the corporate level so that they can then start to play around with how many of each type of activity would be appropriate, most appropriate for their organisation from a financial sustainability perspective. Again, it doesn't mean that those services that might not attract suitable financial returns, but that are critically important from a mission perspective or a client service perspective, should be closed down. But it does help to demonstrate where the gap is, and it might be that you provide less of those services in order to ensure the financial sustainability works better. Obviously, that target price gap is one part of your decision-making process. You need to compare that target price gap and, if you like, the optimum services that you can deliver, the optimum service mix, with your objects as a not-for-profit charitable organisation and what is best for your client at the end of the day as well. Let's just have a look at how that might look from a disability service organisation perspective. So you might step out each of these services, and you can see the cost per UOM. These numbers are simply made up. They're not real numbers in the sense of being relative to an organisation. They're actually part of the target price gap calculations for NCG, which is the organisation featured in the macro case study. So all of this material is available in that case study in the study guide, and again I would suggest that you go back and read the study guide thoroughly when you're contemplating the issues identified in this webinar. Simply put though, you can see the cost per UOM has been calculated, and again it's calculated in that case study more thoroughly. The target price is also identified, and there's a gap between the target price and the cost per UOM. Importantly, we've also included there historical funding achieved to give you a sense of the difference between what our target price might be and what our gap is. So in other words, we've got both a gap and also a historical funding element to be able to look at the differences between the types of prices. Now this might be very helpful for you in the short term to understand immediate financial sustainability issues. So in other words, if you received $2,200 for accommodation support last year, then the idea of receiving $2,100 or $2,000 is going to be a immediate term issue for you. However, of course, the price gap per UOM is where you want to focus, making sure that the service mix allows you to be as financially sustainable as possible. It is expected, though, that the price gaps between all services delivered under the NDIS are likely to be negative, simply because the NDIS pricing structure doesn't take into account a number of elements that are needing to be taken into account in a proper costing and pricing process. So again, re-emphasising, as I did in the last webinar, the costing and pricing process and the identification of the target price is an important internal process that allows you to then strategize around the gap between what you would like to be receiving for a service and what you actually receive. Now the next element that might be important to think about is how some of these things might be reported to the board or senior staff. Clearly the board or senior staff would be very interested, I would have thought, in this kind of report, this service mix matrix that has been identified on this slide. However, board members and senior staff might also like to have different types of information provided, or rather the same type of information provided in different ways, so that it's a little bit more obvious and a little bit more condensed, if you like, in terms of what is positive or negative. In this particular example, and again this example is available in the study guide and is calculated off of the macro case study, you can see that in fact on this basis 2 accommodation support products are actually achieving a positive price gap, whereas most of the products are achieving a negative price gap, with none just simply being in that neutral position where the price equals the amount required to be recovered. Again, I think it's probably different horses for different courses, so that organisations need to consider what kind of reporting they would be most useful to them, and their boards need to think about that as well. But this is another way to present that kind of data. Finally, governance issues more broadly. It's important, of course, to have a proportionate response, considering your objects and strategy over the medium to long term in terms of this target price gap. It's important also, I think, to ensure that you're informing NDS of your pricing difficulties, so that NDS is better placed to advocate on behalf of the sector and make sure that we're getting the best possible prices for the services that are delivered. Board reporting requirements probably need to be re-evaluated, so the normal traditional data that might have been provided to the boards in terms of, say, financial reports only, might need to be re-evaluated and different types of information provided. Certainly in the context of activity levels, that would definitely need to be provided to the board, so that the board understands not only what the financial position and performance is, but also whether the activities are being achieved within the time frames that have been taken into account to determine the costing and pricing outcome. Activity delineation and key alarm trigger points are also important. So under the NDIS regime, for instance, it's important to understand that activities must be delivered before an invoice can be raised, as opposed to the old systems around many jurisdictions where you had funding in advance. This is a critical aspect, and the activity must be reported on a very regular basis to ensure that you're getting the throughput in the organisation that allows you to be financially sustainable. And then I guess finally, one of the most important aspects is ensuring your board is engaged with the change process, and that the board actually understands better the business in order to be able to advise the CEO and make decisions pertaining to how to deal strategically with the target price gap that's been identified. Finally, I guess control is, of course, essential to the process. Board engagement, reporting, internal and external, looking at forecasting, and as I indicated in the second webinar, going back and making sure that you don't have a culture in your organisation that means people don't admit mistakes. Your organisation will make mistakes in this process. Admitting those errors, identifying them early as possible, and rectifying them is the order of the day. So that's a really important aspect. And I guess the final aspect there is, of course, one that most people listening to this webinar, most people involved in disability services would hold dear anyway, and that is, of course, never forgetting why we're here, the ethical considerations associated with pricing, and particularly service mix, how we determine which services we want to continue with. That concludes this webinar, webinar 6. In the next webinar, we will be looking at costing and pricing under the NDIS. So we'll be looking at the same sorts of issues, but really focusing on the NDIS framework and how organisations might consider risks and nuances associated with that. In the meantime, as usual, we're very happy to have comments and queries directed to us. Our contacts are here on the slide, so please take advantage of our contacts and give us a call if you have any queries or comments. In the meantime, look forward to talking to you at the next webinar. All the best.